Hi guys, so welcome to the 16th episode of Forex for beginners. So on this episode I'm going to be talking about trading divergence. So from the basics, there are two types of divergences. We've got a classic divergence and a hidden divergence. They can be further divided into a classic bearish trading divergence or bullish classic divergence. And then we have bearish hidden divergence and then bullish hidden divergence. So let me get to it. So the classic divergence, like I said, there are two subtypes, the bearish classic divergence and the bullish classic divergence. So please note that in this video, I will describe divergence using the relative strength index, the RSI. Of course, there are other indicators that can also have divergence, e.g. for stochastics, MACD. So why is it important to know about divergence? Like I was talking about in the video on how the market moves. So divergence is important in patterns such as the double top, double bottom, head and shoulder, and the wedges. So these are all types of patterns. If you tune into my other videos where I talk of patterns, you learn from there. But in this one, we're now preparing you to be able to enter trades. So divergence, what is it? It is defined as whenever there is misunderstanding between price and indicator such that they appear to be moving away in opposite direction to each other. So like I said, you can look at this picture here. So price was, this is a bearish classic divergence. So price is in a what? Is in an uptrend. And let's focus on this window, this one, not the hidden one. So what happens is we've got price. I said to define an uptrend, we've got it is price which forms higher highs, higher lows, higher highs, higher lows. But manje, if we now say divergence, we're now saying the RSI is forming lower highs. So we've got this one, number one. So this is a higher high, higher low, higher high. And then the indicator, which is this one, is forming lower highs. That is divergence. The price appears to be moving like as they drew here like this, while this side is drawing like this. So this can actually help in identifying change of direction of a trend. So like I was saying, occurs when price forms higher highs while the indicator forms lower highs, not lower lows, lower highs. And so it is seen in a bullish trend. So when we have got an uptrend, it is usually associated with what the following patterns: a typical M, which is what is given in this video or this example, and then double top, we can actually use these ones. And then we've got head and shoulder, a rising wedge. Then a bullish classic divergence so occurs when we are in a downtrend. So it's bullish because it's signifying that we are buying. It's a bullish reversal pattern. So price will be forming lower lows, lower highs, lower lows, like is illustrated in this diagram. Or at least the indicator will be forming what? Higher lows. And so this is a bullish classic divergence. It's also associated with the atypical W, double bottom, head and shoulder, and falling wedge. So what is a hidden divergence? I'm sure you've been noticing here we've got a hidden, here we've got a hidden. So what is it? Bearish is when price makes lower highs while list. So this is for a bearish one. And when price makes lower highs while list indicator makes higher highs, that's divergence. So hidden, this is signifies buys. So if you see price this side is forming higher highs, higher high this side, higher, this one is the first one, so it's not really a higher something. So higher high, higher low, while list here price is forming lower lows. And so this would signify that price will go up. It is when there is a disagreement, like I defined on divergence, and then a bullish hidden when price makes higher lows while list indicator makes lower highs. So this is an example. Price will be moving up while list the indicator is moving in another direction. We are focusing on these legs. Here it's like this, while listing the indicator is the other way. This is what we basically call a divergence. I'll explain more on the next video where I will start defining what a TDI is, Traders Dynamic Index. So why is it important to know about divergence? Like I said, this is important in reversal patterns, so it helps us to make good entries. And then please tune in on the next episode where I'll be talking about the TDI. But before I do that, you have to understand the components. Hence, I will describe the RSI and the Bollinger, and then followed by what? By the Traders Dynamic Index, aka TDI. Thank you guys for watching. Have a nice day.